Welcome to my channel. I'm Scott, and in this video we're going to talk about mergers and acquisitions. So let's first discuss a high level on the topic. I'll go through some examples and then I'll give you some more info on M&As later. So mergers and acquisitions usually refers to two companies combining. An example of an M&A is when one company acquires 100% of another company. Like for instance, Microsoft is trying to acquire Activision Blizzard. It's planning to pay $69 billion, so it's a really big merger, and the closing should be around mid-2023. But there is a chance there's going to be government interference, because the government wants to make sure antitrust laws are not being violated. Antitrust just means they want to make sure this doesn't become a monopoly. So a company may merge with another company and create a new entity. So company A can merge with company B and then create a new company, company C. And sometimes a company doesn't acquire 100% of another company. They may acquire just certain assets of another company. So a common way for a company to acquire another company is through a tender offer. This is when a company bids to purchase another company's shares at a specific price in a predetermined period. And a tender offer is almost always above the trading price, because why would anybody want to sell their shares for less? So a tender offer may be for 30% more than the stock is trading at. So you get a quick 30% return by selling your shares. But the stock price in the market will go up by the tender offer amount. But if the acquisition doesn't go through, then the price comes back down to where it was, possibly lower. If a tender offer doesn't work, then a company may do a hostile takeover. This is when the acquiring company buys up the target company's shares in the open market. Or they may enter into a proxy fight. The acquiring company may try to replace their management that doesn't want the acquisition to go through. But there are ways to defend against a hostile takeover. There's the poison pill. This specifies the maximum amount a shareholder may own in the company. And if somebody goes over that percentage, then the company will dilute their shares. The way they do this is they issue shares at a discount, or maybe even give free shares to other people. A golden parachute is another type of defense. This is when executives of a company are given a really high payout if they're acquired. So say for instance, you want to acquire another company for $1 million. You think that's what the company is worth. But you find out once you acquire that company, you have to pay 5 executives $100,000 each. That's in their contract if they get acquired. So after you pay $1 million for the company, then you have to pay another $500,000 to these executives. So now your purchase price went up 50%. So you decide not to purchase that company. Of course, golden parachutes deter acquisitions, but that may be a bad thing. What if somebody wants to acquire the company for good reasons, but they don't because there's so many golden parachutes? Other hostile takeover defenses are the crown jewels defense, the Pac-Man defense, and the green male defense. Now let's discuss 5 of the biggest M&As. The largest M&A in history was back in 2000 between AOL and Time Warner for $360 billion. And that was over 20 years ago. Currently, there's only 15 companies that are worth more than $360 billion. Back then, there was a lot fewer. So at the time, AOL was the largest internet provider in the US. The vision was to create a massive company that would dominate news, publishing, music, entertainment, cable, and the internet. Unfortunately, with the dot-com crash, AOL really suffered. And the companies ended up spinning off and becoming separate entities. And now AOL isn't even publicly traded. It's part of Yahoo News Group. The idea of an M&A is to make two companies even better. In the last example, that did not happen, but in the next few examples, they were fairly successful. Dow Chemical and DuPont. This was announced in 2015, but the red tape takes a long time. It took 2 years for the deal to be completed in 2017. It was a $130 billion merger of pretty fairly equal companies. And that's not always the case. It's usually one really big company acquiring a small company. And the idea of the merger was to create a highly focused business in agriculture, material science, and specialty products. And the merger was expected to create $3 billion in cost synergies and another $1 billion in growth. And the combined company is still operating today as Dow DuPont, ticker DWDP, and that's listed on the New York Stock Exchange. And no mergers are perfectly equal, but this is fairly equal. Dow shareholders received 1 share of the new entity, and DuPont shareholders received 1.282 shares of the new entity. Now let's look at Anheuser-Busch InBev and SABMiller. This is a merger between the 2 largest brewers. It was worth $104 billion and completed in 2016. SABMiller is a London-based company, and Anheuser-Busch InBev is a Belgium-based company. The goal was to combine SABMiller's Castle Lager with InBev's Budweiser, Stella Artois, and Corona. And the way these companies marketed the merger to their shareholders was saying that this is going to really help them in the really fast-growing African and Latin American markets. SABMiller accepted a bid 50% higher than its closing price 1 day before the media spread the word about the merger. So if you owned SABMiller before the merger, you could have got a 50% return overnight. The next is a $100 billion merger between Heinz and Kraft. And this merger was announced in 2015 and created the Kraft Heinz Company. The goal was to create a massive US food and drink company. The merger put under one roof really big brands: Philadelphia cream cheese, Capri Suns, Heinz ketchup, and many more. And the revenues of the new entity were a whopping $28 billion. Probably the most successful merger ever was Exxon and Mobil. In 1999, the 2 oil giants merged. They did receive FTC approval for the $81 billion deal. Exxon was number 1 pre-merger and Mobil was number 2. There's always a concern when number 1 and number 2 merge, it would create a monopoly and make it unfair for everyone else. But they did get approval since they were not violating antitrust laws. Even though the merger was really successful, there were still hiccups along the road. They had to sell 2,400 gas stations across the US. And the joint entity trades on the New York Stock Exchange under ticker XOM. So how are mergers structured? Mergers can be structured in a lot of different ways. They could be a horizontal merger when 2 companies are in direct competition but share the same product lines and markets. There's a vertical merger when a supplier merges with a company it supplies to. Think of an ice cream maker merging with a cone supplier. There's the kin generic mergers when 2 businesses that serve the same consumer base in different ways. An example is a TV manufacturer merging with a cable company. You have market extension mergers when 2 companies that sell the same product but in different markets. There's product extension mergers, 2 companies selling different but related products in the same market. Then there's conglomeration, 2 companies that have no common business areas. Let's talk about how mergers are financed and valued. A company can buy another company with cash, stock, debt, or a combination of the 3. Say you started a dry cleaner in your town and you had it for 15 years, it's pretty successful. And then a competitor in a neighboring town wants to expand, so they offer you $500,000 for your business. If that other company has a $500,000 in their bank account, they could just write you a check for $500,000 and it's an all cash deal. And say that other company doesn't have $500,000 of cash in their bank. They have about half that. So they take a loan from the bank for $250,000 and then they write you a check for $500,000. It would finance with half with cash, half with debt. Or they may offer you stock in the new company. Maybe they give you $400,000 of cash and $100,000 of stock. So if the person taking over your dry cleaner subsequently sells the business 10 years down the road, you get a piece of that sale. A reverse merger is when a private company acquires a public company. This is a quick way to become publicly traded and get access to the capital markets. This is similar to a SPAC. Always both companies in the deal will have different values for the target company. If you're selling your company to someone, you want the highest price possible. And if you're buying someone else's company, you want to pay the lowest price possible. But there are some common ways to value a company. There's the PE ratio, the value of the company, the market cap over annual earnings, and you'll pay a multiple of this ratio. The multiple will depend on the industry you're in and some other factors. You have the EV to sales ratio, enterprise value over sales. Enterprise value is market cap plus debt minus cash. And you divide that by the annual revenue. And once again, you will pay a multiple of that ratio. You have the discounted cash flow model. We talk a lot about this on this channel. This is when you estimate the future cash flows of the target company and discount that value back to today's dollars. And a not so common way is the replacement cost, the cost of replacing the target company. So the acquiring company can force the target company to sell at that price, or they'll just create a competitor at the same cost. Obviously for a tech company, replacement cost is really difficult to value. Or a company that has a really strong brand name, like McDonald's or Tesla. It's hard to value using replacement cost. But I just threw this in because it's an interesting way to value a company, even though it's not commonly used. So hope you learned something new. Leave a like, comment, subscribe. Talk to you soon.